Welcome to the deep dive. We've gone through the Dole Q2 2025 results, the call transcript, everything. And well, we're here to cut through the market noise and figure out the real story, because this was a quarter. I mean, on paper, it looks strong, good numbers, a big strategic move they finally pulled off.
Yeah, that strategic milestone, the fresh vegetables divestiture. Everyone knew it was coming. But here's the puzzle, right? You got solid beats on revenue, adjusted earnings, and then boom, the stock drops. Over 8% on the day.
Yeah.
Heavy volume, too. It just screams that the market has some deep-seated fear about the quality here, or maybe the sustainability.
Exactly. So that's what we're doing today. We need to unpack that disconnect, strong numbers versus this extreme caution from investors. Let's start with the headline results. What did the quarter actually deliver?
Okay, so the top line financials looked, well, pretty robust, actually. Revenue came in at $2.428 billion. That's a big jump, 14.3% year over year. And even like for like, taking out currency and structure changes, it was up 12.1%, comfortably ahead of what analysts expected.
Okay, strong revenue. What about profits?
Adjusted EBITDA, that was also up 9.3% growth to $137.1 million.
And the number people often focus on, the adjusted earnings per share.
Right. Adjusted diluted EPS, that hit 0.55 cents, which is a solid 12% jump year over year. Also beat expectations. Looks good.
It looks good. But you hinted there's more to it. The JAP number was way off.
Yeah, and this is crucial for, our listeners who really dig into the details. The official statutory number, the GAAP diluted EPS, was way down at just 10 cents. And that massive difference, it's almost entirely down to a non-cash accounting adjustment. It's tied to the discontinued operations, that vegetables division they just sold. So you really have to look past that GAAP noise to see the underlying business performance.
Okay, that makes sense. And that brings us nicely to the big strategic piece. The fresh vegetables divestiture. They finally got it done August 5th. What were the terms? Because the details really matter for how clean the company is going forward.
Right. It was a fairly complex deal, actually. Total value around $140 million. But the key part, $90 million of that was immediate cash. Cold, hard cash.
Okay, $90 million cash is good. What else?
Well, then you had two other bits. A $50 million seller note. It's a 5-year note, paying 5% interest, but it's a PIC note. And then a potential $10 million earnout based on future performance.
Hold on, let's just pause on that PIC note. PIC, payment in kind. Can you just quickly break down why that matters for Dole right now?
Sure. Payment in kind, PIC, yeah. Basically, instead of Dole getting cash interest payments each year on that $50 million note, the interest just gets added to the total amount owed. It accrues. So Dole doesn't actually see cash from the interest payments in the short term.
Ah, okay. So it conserves their cash flow now. They get the big chunk up front, the $90 million, and don't have interest payments from the buyer coming in immediately, but also don't have to worry about servicing immediate interest to the buyer if it were structured differently. It lets them use that $90 million right away.
Exactly. It maximizes the immediate impact of that cash. And the plan for that $90 million is crystal clear. Pay down short-term debt, get the balance sheet leaner.
And they also talked about getting rid of stranded overheads. What exactly are those? It sounds like corporate jargon.
It is a bit, yeah. Stranded overheads are basically the central costs, maybe shared IT systems, central finance teams, management functions that used to support the vegetables division. Now that vegetables gone, those costs are still technically sitting within Dole. So management's job now is to cut those costs out fast, or maybe reallocate those people if possible.
And the benefit is?
Cleaner margins. If they get rid of those stranded costs quickly, the profitability of the remaining business, the continuing operations, should get a noticeable boost. It's key to unlocking the value from the sale.
Okay, so cash for debt plus potential margin upside from cutting costs. But there is something else interesting in the deal terms about some properties.
Yes, this was quite smart, actually. It adds a bit more value than just the headline number suggests. Dole managed to keep the use of 2 important facilities, one in Yuma, one in Heron, and they get to use them rent-free for 5 years. Management put a number on that they reckon the value of that rent-free period is around $40 million.
So effectively, the total strategic value they extracted is closer to $180 million, not just the $140 million sale price, if you include that rent benefit. And they buy themselves time on what to do with those sites long term.
Precisely. It makes the whole divestiture look, well, quite a bit better structured.
All right, let's switch gears to the actual operations. Fresh fruit, still their biggest segment, pulled in $72.7 million in adjusted EBITDA. Driven by bananas and pineapples, good volume, good pricing. Sounds great on the surface.
But it was earned through, let's say, significant headwinds.
Yeah.
The fresh fruit is definitely where the volatility is right now. They're still dealing with higher sourcing costs from recovering after Tropical Storm Sara last year. That meant big reinvestment in Honduras. Insurance helps, sure, but it's still a drag.
And it wasn't just their own problems, right? The whole industry supply seems tight.
Absolutely. That's the bigger issue, maybe. Competitor problems, like Chiquita having issues in Panama, that tightens up the whole market.
Which means if you need extra fruit, you're forced into the spot market, like in Ecuador.
Exactly. And spot market prices, especially in Ecuador right now, are high. So that drives up their costs significantly.
And that cost pressure, that's the cloud hanging over the next couple of quarters.
That's the fear. That's what the market latched onto. But, and this is the crucial counterpoint, this is why the other parts of Dole are so important now. The diversified segments.
Right. The diversified EMEA and diversified Americas. How did they do?
Rock solid. Really strong. Diversified EMEA, that's Europe, Middle East, Africa, saw 8.7% like-for-like adjusted EBITDA growth. That was mainly driven by strong retail sales, especially higher margin stuff in places like the Nordics, Ireland, Spain.
Okay, good growth in Europe. What about the Americas?
Even better, actually. Diversified Americas was up a huge 26.6% on a like-for-like adjusted EBITDA basis. That came from strength in their Southern Hemisphere exports. Think apples, citrus fruits, kiwi, avocados, stuff that's less volatile than bananas, maybe.
So the underlying story, or maybe the investment thesis here, is that this global diversification really helps smooth things out. When bananas are facing storms or supply squeezes, the more predictable growth from avocados or apples in Europe and the Americas kind of stabilizes the whole ship.
That's exactly the idea.
Yeah.
It acts as a hedge. And this really brings us back to what you called the guidance paradox.
Yeah, paradox is the right word, because management actually raised their full year guidance for 2025 adjusted EBITDA. The new range is $380 million to $390 million. I mean, that's usually a clear sign of confidence, right? They expect the continuing business to do better than they previously thought. So why sell off?
Because the market heard two conflicting things at once, I think. They heard the higher number, yes, but then they listened really closely to the Q&A session. And in the Q&A, management was quite clear. They said these supply issues, the higher costs, they expect them to continue, maybe even get worse in Q3. They specifically said they were taking a conservative view with the guidance, which implies, reading between the lines, a weaker Q3 compared to the strong first half. A necessary slowdown in the second half growth rate.
Okay. So raised guidance, but with a big warning sign attached about the very next quarter. Classic investor anxiety trigger. The traders just zoned in on the immediate banana problem, not the bigger picture strategic cleanup.
Pretty much. And it overshadowed the fact that the company's financial footing is actually much stronger now. They did that big $1.2 billion debt refinancing back in May, pushed out maturities, stabilized the balance sheet quite nicely.
And the cost of servicing that debt is coming down too.
Yeah. Expected interest expense for the full year, fiscal 25, is now guided lower, around $67 million. That reflects both the refinancing benefits and the debt paydown they'll do with that $90 million cash from the sale.
Okay, so debt looks better managed. What about just keeping the lights on the basic investment needed, CapEx?
Maintenance CapEx for the parts of the business they're keeping is guided pretty stable, around $100 million, which is roughly in line with depreciation. So it suggests they're not, starving the business of necessary investment. The underlying cash flow profile looks reasonably predictable, barring these big macro swings.
Right, macro swings. They mentioned FX, input costs, and tariffs. Tariffs are always a worry for a global company like Dole. What's their thinking there?
Management seemed pragmatic, but maybe quietly confident. They're actively lobbying Washington. Their argument is basically, look, things like bananas and pineapples, we don't really grow them commercially in the U.S., so why slap tariffs on them? They should be exempt. They admit there might be some, short-term disruption or noise around it, but they seem to expect a reasonable outcome eventually.
And their confidence seems pinned on the idea that they can just pass any extra costs through. They talked about low price elasticity for bananas.
Yeah, that was a key point they made. Low elasticity basically means they think that even if they have to raise the price of bananas, say because of tariffs or higher transport costs, people will still buy them. The thinking is there isn't a readily available substitute grown domestically, so consumers will just, suck it up and pay a bit more. Demand is sticky or inelastic.
What's the risk there? I mean, can you always pass on price hikes?
Well, that's the gamble, isn't it? In a really high inflation world, maybe consumer behavior changes faster than expected. Maybe people do start switching to cheaper domestic fruits or just buy fewer bananas overall. That assumed pricing power could theoretically evaporate. it's something to watch.
Definitely. Okay, one last thing on strategy. They mention looking at future growth, internal projects, M&A.
Yes, they confirmed they're studying internal growth options. Scandinavia, Spain, Ireland were mentioned, also Chile and Peru. And interestingly, they said they are actively looking at external M&A targets.
M&A, what was interesting about that?
Well, they specifically mentioned this valuation gap, meaning they see their own stock price is pretty low right now compared to the prices of some private companies they could potentially buy.
So they're hinting they know they're undervalued on the public market and might use that difference to their advantage somehow.
That's the implication, yeah. They see attractive private targets and their own currency, their stock, looks cheap. It sets up an interesting dynamic.
That valuation gap comment, that's actually the perfect lead-in. Let's shift gears here. Put on our slightly more speculative hats.
Right.
This is not financial advice segment. Purely exploring the, let's say, outrageous but plausible trade ideas that bubble up from digging into these earnings. Remember, always do your own homework.
Okay, so our high conviction pitch, let's call it the clean P&L M&A catalyst bet.
Yeah.
The core idea is this. The market is completely, almost obsessively focused on the short-term static, the Q3 banana supply headache, the cautious guidance tone. They're treating Dole like it's just a volatile banana company.
But that misses the huge transformation that just happened, right? They executed this major strategic simplification with the vegetable sale. The balance sheet is cleaner after the refinancing, and crucially, they have that $90 million in cash sitting there, dry powder. So the company is arguably strategically clearer and financially stronger than it's been in years. Yet the stock is trading at a discount precisely at this moment of improved clarity.
So the bet is this. We think there's a strong possibility, maybe over the next 12 months, so you might look at, say, long-dated call options, that management leverages this situation. They take that $90 million cash, maybe add a bit more clean debt capacity now that the structure is better, and they pull the trigger. They make a strategic bolt-on acquisition, something immediately accretive.
And likely in one of those more stable, higher growth, diversified segments, right? Maybe expanding that retail footprint in Europe they talked about.
Exactly. Could be EMEA, could be something else in the diversified space. A move like that would do two things instantly. One, it accelerates the shift away from relying so heavily on the volatile fresh fruit segment. It beefs up the resilient part of the business.
And two, it's a massive signal of confidence from management, basically saying, yes, our stock is ridiculously cheap right now, and we're going to use this opportunity. An M&A announcement like that could force the market to change the narrative. It could be the catalyst to get investors to look past the short-term weather and supply issues and focus on the improved structure, triggering a re-rating of the stock's multiple. It's basically a bet on management executing on the strategy now that the decks are cleared.
Yeah, it connects all the dots, the divestiture, the cash proceeds, the acknowledged valuation gap, the stated interest in M&A. It's a logical argument for why the long-term structural improvement might be undervalued right now.
Okay, so let's wrap up this deep dive on Dole Black's Q2 2025, the headlines. They beat expectations, they raised the full year guidance.
But yeah, the operational complexity, especially in fresh fruit, and that cautious tone about Q3, that clearly spooked the market in the short term, led to the sell-off.
The real story here, though, maybe isn't about the price of bananas next quarter. It's about the strategic cleanup, getting rid of vegetables, fixing the debt structure. They've arguably improved the fundamental cost and capital base for the long haul.
Exactly. The market punished them for temporary supply chain issues, perhaps without fully appreciating those structural gains.
So the big question we leave you with is this. Will that resilience we saw in the diversified businesses, combined with this much healthier balance sheet, ultimately prove that enduring this patch of volatility is worth it for the long-term value creation?
We'll definitely be watching to see what they do with that $90 million cash injection. That could be the next major signal. Thanks for tuning into this deep dive.
Stay informed, and we'll catch you on the next one.